Most people have received financial advice their entire lives. Save more, spend less, work harder, invest early. And yet most of the people who followed that advice are still working for money at 50, 60, and 70 years old. Still calculating, still waiting, still tired. Let that sit for a moment. Not as an insult, as a mirror. Advice tells you what to do. Laws tell you how the system actually works. The wealthy did not follow better advice. They understood better laws, 7 of them specifically. Laws they never violate, systems they never compromise. Principles that do not care about your feelings, your background, your income, or your intentions. They operate the same way for everyone who touches them. And once you understand what those laws are, you will never see money the same way again. This is not motivation. This is not theory. This is not a set of tips you can post on your wall and forget. This is the structural framework that separates the quietly wealthy from everyone else who is still waiting to feel financially free. 7 laws, applied without exception, starting today. You were taught to work. You were not taught to build. You were taught to earn. You were not taught to own. You were taught to save inside a system designed to slowly consume your savings. That ends here. Not with excitement, with clarity. Sit with that, breathe once, and listen. Chapter 1. Why advice never made anyone wealthy. There is a quiet exhaustion that lives inside people who have done everything right and still feel financially trapped. You know that exhaustion. You have felt it after another paycheck disappeared into obligations that grow faster than your income. You have felt it standing in a store, calculating whether a small purchase will move something invisible out of balance. You have felt it late at night when the number in your account does not match the effort you put into earning it. That feeling is not laziness. It is not failure. It is the natural result of following advice that was never designed to make you free. The truth is, most of the financial advice you have received in your life was written by people who were paid to give it, repeated by people who never tested it, and consumed by people who never questioned it. Save 10%, cut your coffee, pay off your credit cards, contribute to your retirement account. Every piece of it sounds responsible, and every piece of it, followed in isolation, produces the same result. A working person, slightly less broke, still trading time for money at an age when they should be free. Advice is optional. Laws are not. Advice depends on your discipline to work. Laws work whether you cooperate with them or not. Gravity does not require your belief to hold you to the ground. Compounding does not require your approval to multiply capital. Leverage does not care about your comfort level. These are the operating principles of the financial world. They function the same for the janitor in Vermont and the hedge fund manager in Manhattan. The only difference is who is aware of them and who is building around them. This is where most people stop. They stop because they never realized there was a distinction. They believed the game was about earning more, saving more, and hoping the math worked out. So they optimized their side of the equation and never asked what the equation actually was. They tightened their budget, while the system quietly transferred their labor into someone else's asset column. They followed advice while ignoring law. And no amount of advice can overcome a law you are unconsciously violating every single day. Consider Ray Dalio. He founded Bridgewater Associates from a 2-bedroom apartment in New York. He did not build the largest hedge fund in the world by finding better financial tips than anyone else. He built it by asking a question most people never ask. How does the economic machine actually work? Not how do I feel about it, not what should I do about it. How does it operate at a mechanical level? He studied the flow of credit, the cycles of debt, the movement of currency, the behavior of markets across centuries. And then he built his entire investment philosophy around the laws he identified. He wrote his principles down so his team could apply them without him. He often said that principles matter more than instructions because principles keep working when instructions become outdated. Markets change, laws do not. Now understand what this means for you. Either advice or law influenced every financial decision you have made. If you paid off a credit card faster than you built an income-producing asset, you were following advice. If you saved money in an account that lost value to inflation while telling yourself you were being responsible, you were following advice. If you bought a bigger house because you got a raise, you were following advice dressed up as reward. None of those decisions are inherently wrong, but none of them are governed by law. They are surface responses to symptoms, not structural moves aligned with how money actually behaves. The advice seeker looks for the next tip. The law follower studies the next principle. The advice seeker feels temporary relief when a strategy sounds smart. The law follower feels a permanent sense of clarity when a principle proves consistent. The advice seeker asks, "What should I do?" The law follower asks what is actually true. And that shift in question, small as it sounds, is the difference between spending 40 years working and spending 40 years compounding. You will be introduced to 7 laws in the pages that follow. You will not need to memorize them. You will need to internalize them, because once you see them, you cannot unsee them. Once you understand how money actually moves, you will notice every place in your life where you have been fighting the current instead of using it. You will notice the friends who repeat advice they never tested. You will notice the products marketed to keep you responsible but never free. You will notice the quiet violence of a system that rewards effort just enough to keep you working and never quite enough to let you leave. The truth is, wealth was never a mystery. It was a discipline hidden inside a distraction. The people who have it are not smarter than you. They are not luckier than you. They are aligned with something you were never taught to see, and that alignment starts with the first law, the one on which every other law depends. The one most people violate every time they earn $1. Chapter 2. Law 1. Assets feed you. Liabilities drain you. Failure is a moment in every honest person's financial life when they look at their possessions and realize something quietly disturbing. Most of what they own is slowly being taken from them. The car in the driveway costs more each year than it produces. The house is not building equity fast enough to outrun the interest. The subscriptions renew without notice. The closet is full, the account is not, and the thought arrives, unwelcome and precise. Something is wrong with the shape of this. That moment is not a crisis, it is a beginning. Because the moment you can see the shape clearly is the moment you can change it. And every change begins with a single distinction that most people never learn to make with precision. An asset puts money in your pocket. A liability takes money out of your pocket. That is not a metaphor. That is not a philosophy. That is a definition. And once you accept that definition without rationalization, you begin to see your entire financial life differently. The truth is, the modern middle class was taught to buy liabilities and call them assets. A house you live in and pay for every month is not producing income, it is consuming it. That does not mean it is a bad decision. It means it is not an asset in the strict financial sense. A car that loses value the moment it leaves the lot is not an investment in your future. It is a monthly transfer of your labor into someone else's revenue. A wardrobe full of items you rarely wear is not a reflection of success. It is a museum of decisions made under emotional pressure. None of these things are moral failings. They are simply liabilities that have been marketed to you as assets. And the marketing worked because the distinction was never taught. Fairnias mon biam kambof, dinasum the strengthening in mismanium. Ask one question of every purchase. Does this put money in my pocket or take it out? That question, asked honestly and often, will restructure your financial life more effectively than any budget ever will. Because a budget tells you how to divide what you already earn. This question tells you how to change what you become. Warren Buffett bought his home in Omaha in 1958 for $31,000. His net worth has passed $100 billion. He still lives in that same house, not because he is cheap, not because he does not appreciate comfort, because he understood the law. Every dollar not spent on lifestyle inflation was a dollar available to be deployed into assets that produced more dollars. He treated money the way an employer treats employees. Each dollar had a job. Each dollar was expected to bring back more dollars. Dollars that were consumed were dollars retired from service, and he was in no hurry to retire his workforce. Pins to consume it. A promotion happens. Immediately, a bigger house is bought, a nicer car is leased, a longer vacation is planned. The income grew, the freedom did not, because every additional dollar was assigned to a liability before it had a chance to become an asset. And after 20 years of this pattern, the person looks back on their life and cannot understand why higher income has never produced more freedom. The math is simple. Liabilities scale faster than income when consumption is emotional rather than structural. This is where most people stop. They stop because the distinction feels uncomfortable when applied honestly. It forces you to admit that the beautiful car in the driveway is a monthly wound, that the second home in the mountains is a slow bleed disguised as success, that the collection of gadgets is a graveyard of decisions made when you were tired. It is easier to blend the words asset and liability than to separate them cleanly, because separation demands responsibility, and responsibility demands change. But you are not most people. You are reading this because you are willing to see clearly. So see clearly. Look at your spending from last month and mark each item with 2 letters. A for asset, L for liability. Do not argue with yourself. Do not invent categories. Do not tell yourself that the expensive coffee machine is an asset because you save money by not going out. If it does not produce income, it is a liability. That does not make it wrong. It makes it accurate. Now here is the part that changes everything. Your first asset does not require much money. It requires a shift in how you deploy the money you already have. A small position in an index fund is an asset. A book that teaches you a skill that raises your income is an asset in disguise. A course that produces a certification that unlocks new work is an asset. A cash-flowing room rental is an asset. The point is not to buy expensive things. The point is to buy productive things. The first asset is not the largest. It is the first proof that you can shift the direction of a dollar's travel. The wealthy do not fear money leaving. They fear money leaving without producing more money before it goes. That is the entire discipline. Every dollar has a purpose. Every dollar is either working, resting between assignments, or being retired for consumption. And retirement of a dollar is done consciously, not accidentally. The truth is, most people are not broke because they earn too little. They are broke because they consume before they compound. They spend the raise before it compounds. They upgrade the lifestyle before the assets can catch up. They confuse the appearance of wealth with its structure, and appearance is expensive. Structure is free. All it costs is the discipline to know the difference. You have just met the first law. Every other law you will meet depends on it, because you cannot leverage what you do not own. You cannot compound what you never accumulated. You cannot reinvest what you already spent. Everything starts here, with the ability to look at a purchase and know, without emotion, whether it is feeding you or draining you. Fairly is a moment in every honest trade. The next question becomes inevitable. If assets are the foundation, how do you get them to work harder than you can? How do you make them multiply beyond what your own hands could ever produce? That is the next law, and it is the one that changes ordinary savers into extraordinary owners. Chapter 3, Law 2. Leverage multiplies what you own. There comes a point in the financial life of every disciplined person when they realize that discipline alone is not enough. You can save every dollar, you can budget every category, you can eliminate every unnecessary expense, and still the ceiling of your own effort will limit you. Because your 2 hands, your 1 mind, your 24 hours are finite, and the world does not reward finite effort with infinite reward. It rewards finite effort with finite reward. The wealthy understand this at a level most people never reach. They stop trying to work harder inside their own capacity and start extending their capacity through leverage. Leverage is a word that has been abused by marketers. It sounds like a slogan. It is actually a physical law borrowed from mechanics. A small force applied through a lever produces a larger force at the other end. In finance, leverage means using something other than your own effort to produce results larger than your own effort could produce. That something can be capital that is not yours, time that is not yours, systems built by others, or platforms that distribute what you build to audiences you could never reach alone. The truth is, everything in the wealthy world runs on leverage. The banker who holds your savings is using your capital as collateral to make loans that generate interest for the bank. The company you work for is using your time as leverage to produce revenue that exceeds your salary. The investor who buys a rental property is using the bank's money as leverage to control an asset far larger than his own down payment. Leverage is not a special tool for the rich. Leverage is the tool that made them rich. And the tragedy is that most people participate in someone else's leverage strategy every day of their lives without ever using it themselves. Consider the mortgage. 20% down on a property allows you to control an asset worth 5 times your capital. Rent from tenants covers the debt on that asset. Over time, the debt shrinks, the property appreciates, and the equity that grows belongs to you. Your original capital was multiplied by 5 before a single dollar of income was added. That is leverage in one of its most accessible forms, and it is available to anyone with a stable income and a willingness to learn the game's terms. But leverage is not only financial. There is human leverage. Every person you hire, every partner you bring in, every specialist you contract is a form of leverage. They do what you cannot do, or what you should not spend your time doing. There is systems leverage. Every automated process, every documented procedure, every piece of software running in the background is leverage. There is platform leverage. Every audience you build, every channel you own, every subscriber list you maintain is a form of leverage. The wealthy stack these forms of leverage, not one at a time, simultaneously, and each layer of leverage multiplies the output of the previous layer. Andrew Carnegie is one of the clearest examples in history. He arrived in America as a poor immigrant. He had no capital, no education, no advantages. He worked as a telegraph operator and railroad clerk in his early years. And then he did something ordinary people rarely do. He observed how capital moved. He noticed that the men making real money were not the ones working the hardest. They were the ones controlling systems and borrowing capital to build things larger than themselves. So he borrowed. He built steel mills using other people's money. He hired experts smarter than him in specific fields and gave them ownership stakes, so they treated the business like their own. He borrowed capital, he borrowed talent, he borrowed distribution, and at the end of his life, he was worth hundreds of billions of dollars in today's terms. He once said he would rather build a business that employed 1,000 excellent people than personally master every skill himself. That single sentence contains a philosophy of life that most people never adopt. This is where most people stop. They stop because leverage requires trust. It requires letting go. It requires borrowing capital when you were taught that debt is dangerous. It requires hiring people even though you were taught to save on labor. It requires building systems when you were taught to be indispensable. Every one of those defaults keeps you inside your own capacity, and your own capacity, no matter how impressive, has an upper limit. Leverage removes that limit. Understand the distinction between productive debt and consumer debt. This distinction is the difference between wealth and bondage. Productive debt is debt taken on to acquire an asset that generates income exceeding its cost. A mortgage on a rental property that cash flows positively is productive debt. A business loan that funds equipment producing revenue is productive debt. A student loan that leads to a certification that doubles your income can be productive debt. Consumer debt is debt taken on to acquire a liability that produces no income. A credit card balance for a vacation, a car loan for a depreciating luxury vehicle, financing for a lifestyle that outpaces your earnings. That is consumer debt. And consumer debt is the reverse of leverage. It is leverage applied against you. Where productive debt multiplies your assets, consumer debt multiplies your obligations. Same tool, opposite direction. Rockefeller built Standard Oil not by working harder than his competitors. He built it by systematizing leverage at every level of the operation. He negotiated better shipping rates because he shipped more volume. He acquired competitors using stock and financing rather than cash. He integrated vertically so that each part of the operation supplied the next. He layered leverage upon leverage until his company controlled 90% of the American oil industry. He did not sleep less than his competitors. He designed better systems than his competitors. The truth is, the person who works harder within their own limits will always lose to the person who works smarter with borrowed resources. That is not a moral statement. It is a mechanical one. Time is fixed, effort is fixed, but leverage is not fixed. Leverage can be expanded, layered, and compounded. And once you begin to see leverage as a tool available to you rather than a privilege reserved for others, your entire financial strategy shifts. Start small. Consider one form of leverage available to you right now. Perhaps it is a small line of credit used to acquire an income-producing asset. Perhaps it is a contractor who does work you should not be doing yourself. Perhaps it is a platform that distributes something you have already built. The first act of leverage is always uncomfortable because it involves trusting a system rather than your own hands. But the discomfort is the price of moving beyond your own capacity. Pay it once, and then again, until leverage becomes the default of every decision. Now the question that leverage always raises is timing. If leverage multiplies what you own, and if what you own grows over time, what does time actually do to wealth when you leave it alone? That is the next law, and it is the one that turns the patient into a powerful one. Chapter 4. Law 3. Compounding rewards patience above all other qualities. There is a silence that lives inside every real fortune. It is the silence of years spent not doing anything dramatic, not making the perfect trade, not launching the perfect business, not finding the perfect timing, just holding, just waiting, just letting the mathematics of a properly built position do what mathematics always does when it is left uninterrupted. Grow, slowly at first, then quietly, then in a way that seems, from the outside, almost impossible. The world does not celebrate this silence. It celebrates the loud version of wealth, the overnight success, the viral launch, the lottery win, the exit. The world sells you speed, because speed sells, but the actual mechanism that has produced more sustained wealth than any other in history is the opposite of speed. It is time applied to a principle called compounding, and compounding does not reward speed. It rewards the willingness to be patient long after everyone else has quit. The mathematics is simple in a way that hides how powerful it is. $1 invested at a modest rate of return grows slowly for years, almost imperceptibly. You put in $100 and next year you have 108. It looks like nothing. It feels like nothing. And this is exactly where most people abandon the process. They look at year 3, year 5, year 7, and they see numbers that do not justify the discipline it took to arrive there. So they take the money out. They redirect it into something with more visible reward. They tell themselves the strategy is not working. And in doing so, they interrupt the exact process that would have produced the result they were waiting for. Compounding does not work in a line. It works in a curve, and the curve is flat for a long time before it becomes vertical. Everyone can see the vertical part. Almost nobody has the patience to sit through the flat part. That flat part is where the discipline is tested. That flat part is where the belief is built. That flat part is where the future is decided. Charlie Munger, Warren Buffett's partner, said the first rule of compounding is never to interrupt it unnecessarily. That single sentence contains more financial wisdom than most books. Do not interrupt the process. Do not withdraw when the numbers look small. Do not switch strategies when a friend recommends something more exciting. Do not liquidate a growing position to fund a lifestyle upgrade. Every interruption resets a clock that was working in your favor, and you cannot unreset time. The truth is, compounding is not just a financial law. It is a law of every domain where quality accumulates over time. Your skills compound if you practice them consistently and never abandon them for something newer. Your reputation compounds if you deliver consistently and never damage it for a short-term gain. Your knowledge compounds if you read consistently and never trade depth for the illusion of breadth. Your relationships compound if you invest in them consistently and never treat people as transactions. Every meaningful thing in your life is subject to the same curve, flat for a long time, then vertical. Consider Ronald Read. He worked as a gas station attendant and then as a janitor in Brattleboro, Vermont. He never earned a large salary. He never inherited money. He never had a lucky break. He simply purchased dividend-paying stocks in companies he understood, and he held them for decades, through recessions, through market crashes, through bull markets and bear markets, through political changes and economic panics. He did not sell, he did not trade, he did not chase performance, he held. When he died at 92 years old, his estate was valued at approximately $8 million. Every person who knew him was stunned. He had lived modestly, he had dressed simply, he had cut his own firewood. Nobody thought of him as wealthy. But he understood something most people spend their lives not understanding. Compounding works for anyone who respects it long enough to see it operate. He respected it for 60 years, and 60 years of respect produced a result that his neighbors, most of whom earned far more than he ever did, never achieved. This is where most people stop. They stop because compounding requires belief in an invisible process. For the first several years, nothing dramatic happens. The money grows a little. The account looks the same. The world outside is moving fast, and your account is moving slowly. Every social signal tells you to do something else. Every marketing message promises a faster path. And so people leave the process for the promise. They abandon compounding for excitement. They trade a certain slow result for an uncertain fast one. And most of them arrive at 50 years old with less than they would have had if they had simply left the first strategy alone. Understand this at a level deeper than logic. Compounding does not require your intelligence. It requires your absence. Once you set it in motion, your job is to not interfere. Your job is to keep adding, to keep leaving it alone, and to keep resisting the impulse to check its progress every day. People who check their portfolios every hour make worse decisions than those who check them once a year, because emotional interference is the enemy of compounding, and emotional interference is the default state of most human beings around money. The horizon that compounding requires to become genuinely life-changing is longer than most people are willing to consider. 10 years is a beginning, 20 years is a foundation, 30 years is when the numbers become undeniable, 40 years is when the numbers become generational. If you are 30 years old today, the greatest financial gift you can give your future self is to start a small compounding position and never touch it. Not for excitement, not for opportunity, not for the trip that will only be one out of many trips in your life. Do not interrupt the machine. The truth is, every year you delay costs you not just that year's growth, but every subsequent year's growth on that year's contribution. The person who starts at 25 and stops at 35 will often end up with more than the person who starts at 35 and continues until 65. That is not a mistake. That is the curve. Time compounds itself, and the earliest years are the most valuable ones you will ever have. The years you spent waiting to feel ready were the years that would have done the most work for you. There is a kind of quiet grief that comes from understanding this too late, but there is also a kind of quiet strength that comes from understanding it while you can still act on it. And the strength is available to you now, not next year, not when you earn more, not when the market feels safer. Now, because the law does not care about your feelings, it cares about your time. You have seen the value of ownership. You have seen the multiplier of leverage. And now you have seen the compounding that time produces when patience is present. There is one more force that has emerged in the last generation that most people still do not fully understand, a force that allows a single act of creation to produce income across years and decades without your continued labor. That is where the next law lives. Chapter 5. Law 4. Digital systems earn without physical presence. Every generation is handed a specific wealth creation opportunity that the previous generation did not have. The generation before the internet had oil, industry, and expanding real estate. The generation before that had railroads and manufacturing. Each opportunity produced a class of quietly wealthy people who saw what was available and acted while others hesitated. Your generation is not without such an opportunity. In fact, you are living through the largest, most accessible wealth creation window in the history of the human species. And most people are walking through it as if it were not there. The window is digital. It is the ability to create something once, using intellectual and creative work, and distribute it infinitely at almost zero additional cost. That single mechanic changes the economics of wealth building at the individual level in a way with no historical precedent. In the old world, a book had to be printed, shipped, and stocked. In the old world, a course had to be taught in person. A piece of advice in the old world could reach only the room you were standing in. Now a book reaches millions through a single upload. A course reaches thousands through a single recording. A piece of advice reaches the world through a single post, and every unit of that reach, past the first one, costs nothing to produce. The truth is, we live in the first era where an individual with no capital can build assets that produce income indefinitely. That is not a slogan. That is a mechanical truth. And the people who understand it are quietly building empires that look small on the outside because they are digital rather than physical. There is no factory to visit. There is no storefront to see. There is only a laptop, a set of files, and a system that runs whether the owner is working that day or not. Think of a YouTube channel. The videos you produce today keep earning tomorrow. They accumulate views. They surface in recommendations for years. They earn a share of advertising revenue as long as they are watched. They build a brand and a subscriber base that raises the earning potential of every subsequent piece of content. A single video is not a paycheck. It is an asset. And a channel of 200 videos is a portfolio of 200 assets, each earning income while you sleep, eat, or walk in the park with your children. Think of an email list. Every subscriber is a permission slip to communicate directly with a person who has expressed interest in what you offer. That list is not rented, it is not borrowed, it is owned. And each name on it represents future revenue that does not require additional acquisition cost. An email list of 10,000 engaged people can generate more consistent revenue than most physical businesses because the cost to reach them is nearly zero and their willingness to buy is already established. Think of a digital course. A single recording, produced over a few weeks, can sell for years. Someone who has never met you can learn from you, pay you, and recommend you to others. You did the work once. The world pays you many times. None can tristend you. This is the mathematics of leverage applied to knowledge. Once, then infinite. And the barrier to entry has never been lower. You do not need a publisher. You do not need a studio. You do not need investors. You do not need permission. You need something to say, the discipline to say it consistently, and the patience to let the audience build. That is it. And most people will still not do it, because it looks slow, because it looks small at first, because it does not produce immediate applause. Consider Pat Flynn. He was working as an architect in 2008 when the financial crisis eliminated his job. He was studying for a professional certification exam and had created detailed study notes for his own use. Someone in an online forum suggested he sell those notes as a downloadable guide. He priced it at $19. In the first month, it generated nearly $8,000. He had transformed knowledge he already possessed into a digital asset that produced income while he did other things. Over the next 12 years, he built additional digital assets: podcasts, courses, books, software recommendations. By 2020, he had generated over $5 million from a portfolio of digital assets, most of which continued producing revenue long after he stopped actively working on them. He did not have a special skill others lacked. He had a willingness to convert knowledge into product and distribute that product through systems that operated without his ongoing labor. This is where most people stop. They stop because the barrier is not financial. It is psychological. They believe they have nothing to teach. They believe someone else has already said what they would say. They believe the market is saturated. They believe the algorithm is against them, and so they consume others' content instead of producing their own. They build wealth for the creators they watch, rather than becoming creators themselves. Every hour spent scrolling is an hour transferred from your potential asset column to someone else's confirmed one. Understand something with precision. The digital world does not require you to be the best. It requires you to be specific and consistent. There are people earning full incomes teaching subjects that 1,000 others also teach. The difference is not superiority. The difference is that they showed up while the others quit. They kept publishing when the numbers were small. They kept refining when the feedback was harsh. They kept building when the results were invisible. And then, somewhere between year 1 and year 3, the compounding of consistent digital presence began to show. And once it showed, it did not stop. Your personal brand is now the highest value digital asset most people can build, because attention has become the scarcest resource in the modern economy. The person who commands attention consistently, honestly, and usefully becomes a channel through which trust flows. And trust converts to revenue in every industry. Your name, applied to a niche, refined over years, becomes an asset that appreciates faster than most physical investments. The truth is, the tools you need are already in your hand. The camera on your phone is better than the equipment used to record the movies that shaped your childhood. The platforms that distribute your work reach more people in a day than a national broadcast reached in a decade. The audience that would have been impossible to find 50 years ago is now searching, right now, for someone who says what you would say if you started. You do not need to be discovered. You need to publish. consistently, for long enough that the compounding of digital presence begins to produce compound results. This is not motivation. This is a description of the mechanics that are operating right now, whether you participate or not. Someone else is filling the space you could have filled. Someone else is earning the income you could have earned, not because they were better, because they started, and when they started, they did what every wealthy person eventually learns. They built systems that earned while they were absent. That is the digital law, and it sits beside another law that has been building wealth for far longer than any technology has, and will continue to do so long after every algorithm has changed. Chapter 6. Law 5. Property is the oldest wealth system in human history. Before there were markets, before there were currencies, before there were digital assets, there was land. Land was the original asset. Land was the original leverage. Land was the original compound. Every civilization that has produced sustained wealth has been built on the ownership of physical property. Empires rose and fell. Currencies inflated and disappeared. Political systems shifted and mutated. And through it all, the person who owned property others needed continued to accumulate value. That has not changed. It is not going to change, because the human need for shelter, for space, for a place to live and work, does not evaporate with technology. Real estate has built more ordinary wealth than any other asset class in history, not for the already wealthy, for the previously ordinary. The reason is not that real estate is glamorous. It combines all financial laws into a single instrument. It is an asset that produces cash flow through rent. It appreciates in value through time. It can be controlled with leverage through a mortgage, and it protects against inflation because the value of the property and the rent it produces both rise as the value of currency falls. 4 laws in one structure. That is why property has quietly built more fortunes than any other vehicle available to the ordinary person. The truth is, most people misunderstand real estate because they only think about it in one dimension. They think about buying a home to live in and paying it off over 30 years. That is not real estate as a wealth strategy. That is real estate as a lifestyle expense. Real estate as wealth is different. It is the acquisition of a property that other people pay to occupy, while the property itself grows in value and the debt used to buy it is reduced by the payments those other people are making. That is a triple mechanism operating simultaneously: cash flow, appreciation, debt reduction. Consider what that means in practice. Suppose you buy a small rental property. You put down 20% of the purchase price. The bank finances the rest. You find a tenant who pays rent that covers the mortgage, taxes, insurance and maintenance, with a small margin left over. Every month, that tenant is paying down your debt. Every year, property values tend to rise with inflation and demand. Every year, your equity in the property grows through both mechanisms, and your original capital, the 20% down, is controlling an asset 5 times its size. When that asset appreciates by 10%, your capital has effectively grown by 50%, because you controlled the whole property with only a fraction of its value. This is leverage applied to compounding, applied to a physical asset that inflation cannot destroy. This is why property has produced quiet, durable wealth for thousands of years. And this is why the wealthy, once they understand the mechanism, rarely stop acquiring it. Sam Zell grew up in Chicago, the son of Polish Jewish immigrants who had escaped Europe just before the war. He had no family fortune. He had no advantage of birth. He started buying distressed apartment buildings in the 1960s, using small amounts of borrowed capital. His approach was not sophisticated in a technical sense. It was disciplined in a philosophical sense. He looked for properties that others did not want, understood why they actually had value, bought them with as much leverage as he could responsibly manage, and then held them. He improved them. He raised rents as tenants turned over. He refinanced when values grew. He repeated the process across decades and multiple economic cycles. When most investors panicked in downturns, he bought more. When most investors bought at peaks, he waited. By the end of his career, he was a billionaire many times over, having built real estate empires in commercial, residential, and mobile home properties. His often repeated principle was to find something nobody wanted, understand why it actually had value, buy it with leverage, and wait. 4 ideas. A lifetime of application, billions in results. This is where most people stop. They stop because real estate looks intimidating. It looks like something that requires large amounts of money, expert knowledge, and access to deals that ordinary people cannot see. And in the highest levels of the market, that is true. But at the accessible levels, real estate is more available than most people realize. A single small rental property, purchased with a modest down payment and held for 20 years, has quietly produced financial independence for millions of ordinary people around the world. It is not glamorous, it does not go viral, but it works, patiently, decade after decade. For those who cannot yet purchase a physical property, the modern market has opened doors that did not exist a generation ago. Real estate investment trusts allow you to own a share of large commercial and residential portfolios with the same ease as buying a stock. Fractional platforms allow you to participate in individual property deals with small amounts of capital. Crowdfunding platforms allow you to lend to real estate developers and receive interest. The pathways in are many. What is required is not access. What is required is action. Understand something at the level of principle. Inflation is not a temporary problem. It is a structural feature of every modern economy. Currencies lose purchasing power over time. $10 50 years ago bought more than $10 today. $10 today will buy more than $10 50 years from now. This is not an opinion. It is a demonstrated pattern of every fiat currency in modern history. The person who keeps their wealth entirely in cash is silently being taxed by inflation every year. The owner of property is protected because property values and rents tend to rise with inflation. What destroys the saver protects the owner. That is not a coincidence. That is the design. The truth is, real estate is not for the wealthy. Real estate has been the vehicle that has made ordinary people wealthy for as long as ownership has existed. It rewards patience. It rewards leverage used carefully. It rewards the willingness to hold through cycles rather than sell in panic. It rewards those who see property as a long-term relationship rather than a short-term trade. Own what people always need. That is the entire law in 6 words. People will always need a place to sleep. People will always need a place to work. People will always need a place to store their belongings. If you position yourself as the owner of what people always need, and you hold that position long enough, the mathematics of scarcity and inflation will work in your favor, whether you actively manage them or not. You have seen assets. You have seen leverage. You have seen compounding. You have seen digital systems. You have seen property. Each law on its own can build a life of financial stability. Together they build something far greater than the sum. But they build that greater thing only if what they produce is treated properly once it arrives. And what most people do with the income these laws produce is what makes the next law essential. Chapter 7. Law 6. Reinvestment is the engine of all lasting wealth. There is a moment that every earner faces the first time a real income arrives. Perhaps it is the first business profit that exceeds expenses. Perhaps it is the first significant bonus at work. Perhaps it is the first dividend check from an investment. And in that moment, a choice is made, quietly, without ceremony. What happens to this money now? That single choice, repeated over a lifetime, determines whether wealth compounds or evaporates. Because the laws that produce income are only half the equation. What you do with what those laws produce is the other half. and the other half is where most people lose everything they built. The truth is, most people treat income like a reward. They celebrate its arrival. They spend a portion of it. They pay some obligations, and then they wait for the next arrival to do the same again. This pattern feels normal because it is universal, but it is a pattern that guarantees that wealth will never accumulate to a life-changing degree, because a reward that is consumed cannot compound, and compounding, as you already understand, is where lasting wealth actually lives. The wealthy make a different choice. They treat income not as a reward, but as capital. Capital is a resource that must be deployed. Capital does not sit still. Capital is not celebrated. Capital is directed toward the next asset that will produce more capital. The wealthy person receives $1 of profit and does not think about what to buy with it. They think about where to send it so it can produce more dollars. That single reframing, applied over decades, is the difference between a comfortable retirement and a compounding empire. Consider two earners with identical incomes. Both make $100,000 a year. Both live in similar cities. Both have similar life circumstances. One of them treats his income as a lifestyle budget. He upgrades his home to match his salary. He drives a car that matches his position. He takes vacations that match his social circle. His savings account grows slowly. His investments grow slowly. His wealth grows slowly, if at all. 20 years later, he still earns $100,000, or perhaps slightly more, and he still lives paycheck to paycheck, wondering where the years went. The second earner treats his income as capital. He lives in a home well below what he could afford. He drives a modest car. He takes fewer vacations and less extravagant ones. Every year, he directs a large portion of his income into assets. Some of those assets fail, most of them grow, and the ones that grow produce income that he also reinvests. 20 years later, his salary has not changed dramatically, but his portfolio of assets is producing more income than his salary. He has effectively become financially independent, not because he earned more than his neighbor, but because he redirected more of what he earned into things that continued earning without him. Identical income, opposite outcomes, and the sole variable was reinvestment discipline. Consider Jeff Bezos and Amazon. For years after founding the company in 1994, Amazon produced no meaningful profit. Every dollar of revenue was immediately reinvested into warehouse infrastructure, technology development, and new product categories. Wall Street analysts criticized the strategy. Journalists mocked the company. Shareholders demanded returns. Bezos held his position with a discipline that was almost unnatural. He understood that compounding required feeding the system rather than extracting from it prematurely. He was not building a business. He was building a machine that would eventually produce more value than any single quarterly profit ever could. 2 decades later, Amazon's market capitalization exceeded $1 trillion, and every critic who had wanted him to declare quarterly profits and pay dividends was, in retrospect, wanting him to sabotage the very compounding that made him one of the wealthiest people in modern history. The reinvestment period that looked like failure was actually the foundation of one of the greatest wealth creation stories ever recorded. He starved the short term to feed the long term, and the long term repaid him with a scale most people cannot mentally model. This is where most people stop. They stop because reinvestment requires delayed gratification at a level that goes beyond ordinary saving. It requires the discipline to look at real income you earned with real effort, and to send it away from you toward the next asset instead of enjoying it now. It requires you to live below what you could afford, sometimes for a decade, sometimes for 2. While the compounding effect builds, it requires you to answer the same question from friends and family, year after year. Why do you not upgrade your life? You earn more now. Why do you still live like this? And it requires you to answer that question without needing them to understand. The framework for reinvestment is not complicated in structure. It is difficult in application. As a working principle, every stage of wealth building has an appropriate reinvestment percentage. In the earliest years, when total assets are small, the majority of any increase in income should be reinvested. This is because the marginal dollar in the early years does the most work over time due to the length of the compounding curve ahead of it. As the asset base grows, the reinvestment percentage can be gradually reduced to allow for lifestyle expansion, but never to a level that fully consumes the income the asset base is producing. The moment you begin consuming everything your assets produce, you have stopped growing. You have merely become a self-funded employee of your own portfolio. Understand the framework as a rule rather than a preference. Assets should produce income. Income should be split between reinvestment and consumption. Reinvestment should exceed consumption for an extended period before that ratio is allowed to shift. The specific percentages depend on your stage. The principle does not. Reinvestment first, consumption second. That order is the order of the wealthy. The reverse order is the order of the trapped. The truth is, the difference between someone who builds sustainable wealth and someone who does not is rarely about income size. It is almost always about the discipline of their reinvestment. High earners with poor reinvestment discipline retire poor. Modest earners with strong reinvestment discipline retire wealthy. The math is not romantic. It does not care about your salary. It cares about your ratios. There is a quiet joy in watching the assets you have reinvested into begin to produce income of their own. It is a joy that consumption cannot replicate, because consumption is a moment. Compounding is a decade, and a decade of compounding produces the kind of freedom that no purchase ever has. The vacation ends, the dinner ends, the clothing goes out of style. The compounding does not end. It continues while you sleep. It continues while you focus on your family. It continues while you build the next thing. And eventually, it produces a life in which consumption is possible without diminishing anything, because the assets are large enough to generate far more income than any reasonable lifestyle could consume. Every law you have learned so far builds you up. Reinvestment is the law that keeps you built. But even a well-fed system, growing in every direction, must be protected against events that no one can predict. That is where the next law reveals itself. And this law is the one that separates the wealth that lasts from the wealth that disappears in a single unexpected moment. Chapter 8, Law 7. Diversification is protection, not just growth. Everything you have built is subject to something you cannot see. There are events in the world that arrive without warning. Recessions arrive without warning. Pandemics arrive without warning. Political shifts arrive without warning. Currency devaluations arrive without warning. Industries collapse in months that had seemed permanent for decades. And every one of these events has the capacity to destroy wealth that took a lifetime to build, if that wealth was concentrated in a single place. That is why the seventh law exists, not to help you grow faster, but to help you keep what you have already grown. The truth is, diversification has been marketed to the public as a growth strategy. It is not. Diversification is a survival strategy. It is the architecture that ensures no single failure can destroy what all the other laws have built. And the difference between growth and survival is the difference between people who become wealthy for a season and people who remain wealthy across generations. Understand this with precision. If you concentrate all your capital in one asset, one industry, one country, or one currency, you are betting your entire financial life on the continuous stability of that single thing. And in a world where change is the only constant, that bet is not brave. It is naive. You may win for a long time, but when the loss comes, and eventually loss comes for every concentrated position. It takes everything with it. There are countless stories in history of people who were rich in one thing and lost everything when that one thing changed. Real estate barons who held only real estate when the market collapsed. Tech investors who held only technology when the bubble burst. Business owners whose entire net worth was tied up in a company that could not survive a shift in consumer behavior. Every one of them had violated the same law. They were undiversified. Ray Dalio built Bridgewater Associates into the world's largest hedge fund, in part through a single core insight. He could not reliably predict which asset class would outperform in any given year. Nobody could. But he could design a portfolio that would perform adequately in every possible economic environment. He called it the all-weather portfolio because it was built to withstand rain, sun, storms, and drought simultaneously. He allocated capital across stocks, bonds, commodities, and other asset classes in proportions calibrated to different economic conditions. When one condition dominated, one part of the portfolio performed well. When another condition emerged, another part of the portfolio compensated. When the 2008 financial crisis destroyed most institutional funds, Bridgewater returned a profit. Not because Dalio predicted the crash. He did not. His genius was not prediction. His genius was preparation. His portfolio was designed to hold under conditions no one could predict. That is the law of diversification applied at its highest level. Protection is not the absence of risk. It is the presence of a system that limits how much any single risk can take from you. Now understand what diversification actually means, because the word is often misused. Owning 10 stocks in the same industry is not diversification. That is concentration hidden inside variety. Owning multiple properties in the same city, in the same neighborhood, all serving the same tenant demographic, is not diversification. That is concentration in a physical form. Owning several businesses that all depend on the same platform, supplier, or customer segment is not diversification. That is concentration disguised as breadth. Real diversification means spreading capital across genuinely different asset classes that behave differently under different conditions. Real diversification includes stocks, which perform well in growth periods. It includes bonds, which perform well when growth slows. It includes real estate, which performs well against inflation and produces steady cash flow. It includes commodities and precious metals, which tend to perform well during periods of monetary uncertainty. It can include digital assets, which behave differently from traditional financial assets. It can include private equity, which is not correlated with public markets in the short term. It includes different currencies, which protect against the failure of any single monetary system. And it includes different geographies, which protect against the political and economic failure of any single country. This is where most people stop. They stop because diversification requires patience with parts of a portfolio that are not the exciting parts. It requires holding bonds when stocks are rising. It requires holding real estate when technology is booming. It requires holding boring assets that are performing modestly while friends and neighbors post about the concentrated position that is producing dramatic returns. And when the concentrated position eventually reverses, as it always does, the diversified investor is protected while the concentrated one is devastated. But the diversified investor does not receive congratulations for that protection, because society celebrates the winners of concentration and forgets the losers. The disciplined diversifier lives an unglamorous life, and the unglamorous life is the one that survives every storm. There is another dimension of diversification that most people never consider: time diversification. Dollar cost averaging is a form of time diversification. It means investing consistent amounts across regular intervals, rather than trying to time the market with lump sums. This approach removes the emotional trap of trying to predict tops and bottoms, which almost nobody can do consistently. When markets are high, your fixed contribution buys fewer shares. When markets are low, your same contribution buys more shares. Over decades, the average purchase price ends up being lower than what most active traders achieve by attempting to time the market. Time diversification protects you from your own emotional reactions to short-term volatility. Then there is geographic and currency diversification. If all your wealth is denominated in a single currency, you are betting on the long-term stability of that currency. History teaches us that no currency has ever remained stable forever. Every currency, including those that seem most secure today, has experienced periods of significant devaluation throughout its history. Holding assets in multiple currencies or in currency-neutral assets like real estate and commodities protects you from the failure or devaluation of any single monetary regime. This is not paranoia. This is history. Read carefully. Understand the psychology. Concentration feels smart when it is working. Diversification feels foolish when it is working. And then the roles reverse without warning. The concentration that felt smart proves foolish. The diversification that felt foolish proves life-saving. And the difference between the person who survives with everything intact and the person who does not is that the survivor accepted the boredom of diversification long before it was needed. The truth is, diversification is the humility of admitting that you do not know what will happen next, combined with the wisdom of building a structure that does not require you to know. It is the acceptance of your own limits. It is the acknowledgement that even the best forecasters are often wrong. It is the willingness to be less brilliant in exchange for being more durable. And in the long game of wealth, durability beats brilliance every single time. You have now walked through 7 laws. Each one operates whether you cooperate with it or not. Each one has been applied by ordinary people to produce extraordinary outcomes. Each one is available to you starting today. But understanding a law is not the same as embodying it. There is one more layer beneath all 7, and until that layer changes, the laws will slip through your hands even after you have memorized them. That layer is not a law, it is the person applying them. Chapter 9. The Identity Behind the Laws. There is something quiet that happens beneath every financial decision you make. Before the decision is made, before the money is spent, saved, or invested, a deeper choice has already occurred. You have chosen, without noticing, which version of yourself is making the decision, and that version, that identity, is the true architect of your financial life, not the tools you use, not the strategies you learn, not the laws you memorize, the identity you carry into the moment of every decision. The truth is, laws are only as powerful as the identity applying them. You can read this audiobook 100 times, you can memorize every principle, you can quote every example, and if the identity underneath does not shift from employee to owner, the laws will not fully take. They will operate in fragments. They will produce partial results. They will slip through your hands the moment pressure arrives, because pressure exposes identity. And under pressure, you will not act according to what you have learned. You will act according to who you believe yourself to be. Employee identity and owner identity are not job titles. They are ways of processing the world. An employee looks at money as compensation for time. An owner looks at money as a tool for building systems. An employee thinks in terms of raises and promotions. An owner thinks in terms of equity and margins. An employee measures success by title and salary. An owner measures success by autonomy and assets. An employee saves. An owner deploys. An employee retires at a fixed age when a bureaucracy allows it. An owner retires when their systems produce enough for their time to no longer be required. regardless of age. Neither identity is morally superior, but only one of them will consistently apply the 7 laws. Because the laws require the owner's default. Assets and liabilities are the owner's language. Leverage is the owner's language. Compounding requires the owner's patience. Digital systems require the owner's willingness to build without immediate reward. Property requires the owner's willingness to hold. Reinvestment requires owner's discipline to delay consumption. Diversification requires the owner's humility about the future. Every law has an employee counterpart that leaks value. The employee spends the raise. The owner deploys the raise. The employee buys a nicer car. The owner buys a small position in an income-producing asset. The employee counts the years to retirement. The owner counts the years until assets exceed lifestyle. Same tools, different identity. Radically different results. This is where most people stop. They stop because they have been told for their entire lives that financial success is a matter of strategy, when it is actually a matter of self-concept. Strategy layered on top of the wrong self-concept produces temporary results and eventual reversion. Strategy layered on top of the right self-concept produces permanent results and steady expansion. The strategy is external, the identity is internal, and the internal always wins over the external in the long run. Marcus Aurelius, writing to himself 2,000 years ago, said, "You have power over your mind, not outside events. Realize this, and you will find strength." He was not writing about money, but the principle applies with total precision. You do not have complete control over the market. You do not have complete control over the economy. You do not have complete control over what other people do with their capital. But you have complete control over the identity you bring to the moment, and that control is the source of everything else, because identity determines behavior, and behavior, repeated across time, determines outcome. The shift from employee identity to owner identity does not require you to quit your job. That is a common misunderstanding. You can have a job and still be an owner in identity, because the identity is about how you process the income the job produces, how you think about your time, how you allocate your capital, how you plan for a future that is not defined by the paycheck alone. Many owners started while employed. Many are still employed. The employment is a source of capital. The identity is the operating system underneath. Sam Walton opened his first store, a Ben Franklin franchise 5 and dime, in Newport, Arkansas, in 1945. He built it into a successful operation over 5 years, and then the landlord did not renew the lease. Walton lost the entire business through no fault of his own, operational performance. Most people, at that point, would have accepted the lesson and returned to employment. It would have been rational, it would have been safer, it would have been forgivable. But Walton was already an owner in identity long before he was an owner in stability. So he did what owners do. He opened another store, then he opened another, then another. Not because he had more money than the average person. He did not. Not because he had more education than the average person. He did not. He had one thing others did not have: an identity that would not accept employment as the destination, an identity that saw ownership as the only acceptable outcome. When he died in 1992, Walmart was the largest retailer in the world, but the empire did not come first. The identity did. Every decision Walton made was made from the identity of an owner, from the day he lost the first store to the day he built the largest retail operation on earth. The identity did not need the empire's confirmation. The empire needed the identity to build it. Understand this principle carefully, because it is easy to misuse. Identity is not fantasy. It is not affirmation. It is not pretending. It is not visualization. It is a decision. It is the willingness to make choices, small and large, from the position of who you are becoming, rather than the position of who you currently appear to be. Every choice made from the owner identity strengthens that identity. Every choice made from the employee identity strengthens that one instead. And the identity that gets strengthened is the identity that eventually becomes automatic. You start where you are. You do not need capital to begin acting from owner identity. You need only a single decision. Perhaps you begin by treating your income as capital rather than reward. Perhaps you begin by treating your evenings as a time for building rather than a time for consuming. Perhaps you begin by treating small savings as the start of an asset column rather than a rainy day fund. The first act is small. The identity grows through repetition, and the identity, once grown, produces every subsequent behavior naturally. The truth is, most people never build meaningful wealth because they never see themselves as the kind of person who does. They keep the identity that got them where they are and expect it to take them where they want to go. It cannot. The identity that produced the current life will not produce a different life. The identity must change first, and the change is not visible externally at first. It is a private decision, made alone, often at ordinary moments, that quietly reshapes every subsequent choice. You have the tools, you have the laws, you have the examples. All that remains is the identity that will apply them without inconsistency. That identity is a decision you can make today. And once made, it does not need to be announced. It only needs to be acted upon. You have almost reached the end of what this audiobook can teach you, but there is one final concept that ties all 7 laws together into something greater than the sum of your own life. Because the laws applied consistently do not just build wealth for the person applying them, they build a structure that continues long after that person is gone. That is where the next chapter takes us. Chapter 10. Building the financial architecture that outlives you. Everything you have built so far has been for you. The assets, the leverage, the compounding, the systems, the property, the reinvestment, the diversification, the identity underneath it all. Every law has been aimed at your own life, your own freedom, your own future. And that is where most financial education stops. It stops at you. It assumes that the goal is to accumulate enough for a comfortable retirement and to enjoy what you have built in the years remaining. That is a reasonable goal, but it is not the highest goal available to you. The truth is, the 7 laws applied consistently over time do not merely produce personal wealth. They produce something structural. They produce an architecture. And an architecture, unlike a lifestyle, does not die with the person who built it. It continues. It is inherited. It is expanded by those who receive it. And if the philosophy underneath it is transmitted along with the capital, it can outlast every individual life that touches it. That is the highest form of wealth. Not a fortune, a framework. Not wealth for one lifetime, a system for every generation that follows. Consider the difference. Most families that suddenly come into money lose it within 1 or 2 generations. The statistics on this are consistent across cultures and centuries. Lottery winners, athletes who receive large contracts, entrepreneurs who sell businesses, heirs of wealthy relatives, all follow a similar pattern. The money arrives, it is spent, mismanaged, or lost through poor decisions. Within 30 to 50 years, most of the fortune is gone. The next generation is back where the family started, sometimes worse, and the fortune becomes a memory rather than a foundation. Then there are the families that build wealth and keep it across generations. The Rothschilds, the Rockefellers, the Waltons, the Vanderbilts, for many decades before their decline. What made the difference between the fortunes that lasted and the ones that vanished was not the size of the initial wealth. It was the philosophy transmitted alongside it. Because capital without philosophy is a temporary condition. Philosophy without capital produces its own capital over time, but capital with philosophy compounds across centuries. Mayer Amschel Rothschild founded a small banking operation in Frankfurt in the late 18th century. He had 5 sons. He sent one to each of Europe's major financial centers: London, Paris, Vienna, Naples, Frankfurt. He did not just give them capital, he gave them a philosophy, specific principles about how money should be managed, how risk should be distributed, how information should be gathered, how wealth should be reinvested rather than consumed, how to maintain family cohesion across generations. The capital was the visible inheritance. The philosophy was the true inheritance. 200 years later, through world wars, revolutions, economic collapses, and political upheavals that destroyed most contemporary fortunes, the Rothschild family still holds significant wealth and influence, not because the original capital survived unchanged. Wars and inflation would have destroyed pure capital many times over. The wealth survived because the philosophy was transmitted from generation to generation with the same care that the capital itself was transferred. Each generation was taught how to think about money before it was given money to manage. And each generation, having been taught how to think, produced its own version of the fortune rather than merely inheriting it. This is where most people stop. They stop because building an architecture that outlives you requires a longer time horizon than one lifetime, and most people cannot mentally model that horizon. It requires you to make decisions today that will pay off after you are no longer alive to enjoy them. It requires you to plant trees whose shade you will never sit under. It requires a kind of selflessness that consumer culture actively discourages. And it requires you to communicate philosophy to the next generation with the same discipline that you communicated it to yourself. Understand what this looks like in practice. It means formalizing the structure through legal instruments that continue beyond your life. Trusts, estate planning, succession documents. These are not tools reserved for the ultra-wealthy. They are available at accessible levels to anyone who has begun building assets. A simple family trust can preserve assets across generations, protect them from unnecessary taxation, and provide clear rules about how future generations may access and manage them. Without such instruments, wealth passes through inheritance laws that are often blunt and destructive. With them, wealth passes through structures designed to preserve both capital and intent. It also means documenting the philosophy, not just the assets. Write down what you have learned. Write down the laws you have applied. Write down the mistakes that taught you. Write down the principles that guided you, because the next generation will inherit the capital regardless. Whether they inherit the wisdom to steward it depends on whether you took the time to transmit it in a form they can access after you are gone. A letter to your children, a recorded conversation, a written statement of principles. These small acts of transmission are more valuable than most people realize. It also means teaching the next generation while they are still in the room with you. Do not wait until they are adults with careers to introduce them to how money works. Bring them into the conversation early. Show them how you make decisions. Let them see the discipline. Let them see the reasoning. Let them ask questions without judgment. The philosophy is caught more often than it is taught. And it is caught most effectively during ordinary moments, at kitchen tables, in cars, during small daily decisions witnessed over years. The Rockefellers built a family council structure. Every generation meets regularly to discuss family investments, philanthropic direction, and intergenerational values. This is not a hobby, it is a mechanism. It ensures that the philosophy which built the original wealth is refreshed, examined, and transmitted with each new generation. And it has kept that family in a position of significant wealth and influence for more than a century in an economy that has otherwise destroyed most of the fortunes of their era. The truth is, generational wealth is not about the amount inherited. It is about the systems and philosophies transmitted. A modest inheritance combined with a strong philosophy produces more long-term wealth than a large inheritance combined with no philosophy. Because philosophy compounds even when capital fluctuates. And philosophy replaces itself when capital is lost. Capital without philosophy cannot replace itself once spent. There is a final law above all seven that you must understand as the closing principle of everything you have learned. Consistency applied long enough always wins. It wins regardless of starting conditions. It wins regardless of income level. It wins regardless of external circumstances. It wins regardless of setbacks along the way. The person who applies the 7 laws inconsistently for 40 years will be defeated by the person who applies them consistently for 20. Because consistency does not compound. Consistency is compounding. Every interruption resets the curve. Every steady application steepens it. You do not need to be brilliant. You do not need to be exceptional. You do not need to be lucky. You do not need to be born into advantage. You need to be consistent, and you need to be consistent long enough that the mathematics of the 7 laws can operate uninterrupted. That is the entire secret. It is not a secret because it is hidden. It is a secret because it is boring. And boring, applied for decades, produces results that seem magical from the outside because the observers were not there for the decades. You now have the architecture. You now have the philosophy. What remains is the decision to build, and that decision is not made once. It is made every day, in every choice, for the rest of your life. Because the architecture is not built at one moment, it is built at every moment, and the building never ends. It only outlives you. You have heard the laws. You do not need to hear them again. What you need now is silence and time. The world will tell you to do more. The laws will tell you to do less, more consistently, for longer. The truth is, wealth was never a mystery. It was a discipline hidden inside a distraction. Most people will hear this and go back to their lives unchanged. That is not a tragedy. That is a statistic. You are not required to be different. You are only required to decide. Assets feed you. Liabilities drain you. That single sentence, applied without exception, will change more of your life than any strategy you could learn. Leverage is not for the reckless. It is for the disciplined. Consumer debt is leverage aimed at you. Productive debt is leverage aimed at freedom. Learn the difference and never forget it. Compounding does not care about your excitement. It cares about your presence, year after year, without interruption. Digital systems are the printing press of your generation. If you do not use them, someone else will use the space you could have occupied. Property has built more ordinary wealth than any other asset in history. It still does. It still will. Reinvestment is the boring engine underneath every empire. Boring, applied long enough, becomes legendary. Diversification is the humility of admitting you do not know what will happen next, combined with the wisdom of not needing to know. Identity is upstream of behavior. Behavior is upstream of outcome. If the outcome is not changing, look upstream. The wealthy did not follow better advice. They understood better laws. The truth is, most people will keep looking for tips when what they need is principles. You have been given principles. Do not look for more. Look deeper into the ones you have. Do not chase strategies. Choose one law and live inside it until it is no longer a concept, but a habit. Do not tell anyone what you are building. Let the building itself be the announcement. Decades from now, when it can no longer be denied, consistency applied long enough always wins. There is no exception. There has never been an exception. There will never be an exception. Your starting point does not determine your ending point. Your discipline does. Your income does not determine your wealth. Your ratios do. Your intelligence does not determine your freedom. Your patience does. You will be tempted to interrupt the process. Do not. You will be tempted to consume what you should reinvest. Do not. You will be tempted to concentrate when you should diversify. Do not. You will be tempted to compare your slow build to someone else's fast display. Do not. The person you are comparing yourself to is probably not as far ahead as they appear, and even if they are, their pace is not your pace, and their laws may not be your laws. Stay inside your own architecture. Build it slowly, build it correctly, build it in silence. Wealth is not loud, it is quiet. Wealth is not urgent, it is patient. Wealth is not clever, it is consistent. The 7 laws will keep working long after you have finished listening to this. They will keep working whether you cooperate or not. Cooperate, not tomorrow, not next month, not when the income arrives, not when the timing feels right. Today, in the smallest decision available to you today, because every fortune that has ever existed began with a decision that looked, from the outside, like nothing. That is the beginning. That is always the beginning. You have the laws, you have the time, you have the choice. The rest is silence.